Right, welcome back to Bazaar Morning Call. We have plenty of stocks to talk about, so let's get Siddhartha Khemka, the head retail research at Motilal Oswal Financial Services, into our discussion. Siddhartha, hi, good morning. Great speaking with you on the channel. I want to start with the stock that we just spoke about before the break. I don't know if you heard it, the tire space, right? Good numbers, strong earnings from the likes of MRF, CAT, but some of these stocks are not cheap. Any thoughts here? Would you buy them or avoid?
Yeah, very good morning, Sonia. Pleasure to be on the show. I think the overall outlook on the tires is turning out to be positive because of several reasons. And the first one would be the strong recovery that is being witnessed in the OEM sales growth. So after you see last several quarters of supply chain issues, several other issues, things have started falling in place for the auto companies. Raw material prices have come down. They have been able to pass on price hikes. The semiconductor chip availability has improved. So if you look at the overall space, things have been improving. Similarly, for the tire companies, raw material prices was a key concern. That has come down, helping them improve their overall margins. With volume growth now looking much better. Definitely some of the stocks are not looking cheap and they have outperformed. For example, Apollo Tyres trading at its all-time high levels. But if you look at the overall space, as I said, I think we still believe that there is room for further upside. We still have a buy rating on Apollo Tyres with a 400 rupees target price, gives still some upside from current levels. See it again, we believe that post the strong numbers, there is still room for strong growth, margins to sustain at current levels, which should provide further upside to see it as well. So I think these are the two stocks from our tires coverage universe that we have been liking, and we see further upside from current levels as well.
All right. Hi, Siddharth. Morning. I wanted to ask you about these air coolers and AC manufacturers. I think a couple of months when we were getting into the summers, I recall you saying that, some of these stocks look good. Voltas did pretty well. But we have Blue Star that's come out with a very good set of numbers, good order book as well, good top line growth. Between them, who would you go for? I mean, Blue Star's out there, which is giving good growth, good profitability as well. You have Lloyd's, that if you want to play it, you have to play it via Havells, where good growth, but it's giving you negative on the margins, while Voltas is losing market share. So between the three, who?
Yeah, very good morning, Nigel. I think we have seen the strong demand, especially for these ACs and air coolers, given that this year's summer started pretty early in Feb itself. We saw heat wave last month across several states in India. So that has led to the strong demand for the air conditioners, and that has helped these companies report strong numbers. Although, as you rightly highlighted, some of them are losing market share, are still not that healthy in terms of margins. Plus, both
all right,
Voltas
Siddharth,
and
just
Blue Star.
stay on with us. We'll just come back to you in a minute because I do want your thoughts on HDFC as well. The company reported a very strong set of Q4 numbers. The bank reported its lowest gross NPA ratio in 18 quarters and net interest margin at 7-quarter high. My colleague Abhishek caught up with Keki Mistry, the Vice Chairman and CEO. Let's listen in.
If you look at the month of March 2023, which is the last month of the financial year, we had the highest ever level of individual loan disbursements in history. Previous highest had been March of 2022. So the growth momentum continues to be strong. You will always see 1 month, 2 months here and there where the growth may be a little more, little less. But generally speaking, the growth momentum is still very strong.
How will the lending rates harmonize between SDFC Limited and the bank on certain products like loan against property, etc.?
So as it happens, every customer who moves into the bank will move at the existing interest rate. So theoretically, if your interest rate today, for argument's sake, is 8.5%, then when you move to the bank also, your interest rate will be 8.5%. Now, the benchmark may move from HDFC RPLR, as we call it today, to a repo-linked product. We see all banks today have both repo-linked loan products as well as they have their traditional own cost-based products. So initially, customers will move to a cost-based product, but they will have the option to move to a repo rate product.
What has been the impact of higher rates on customer preference? Have they postponed their purchase or demand per se, or are you witnessing the momentum to continue despite the rates that have increased?
So the way I would look at it is that a housing loan is very different from a short-term loan. Typically, a housing loan stretches for about 13 to 15 years. Now, in a period of 13 to 15 years, when you take a floating rate loan, interest rates will go up and interest rates will go down. Interest rates are never fixed. Now, today, if rates are high, then at some point of time, rates will come down. Already there is talk of global rates coming down by the end of the year. So at some point of time, you may see rates in India also come down. So if you've taken a floating rate today at a higher rate, your rate will come down. If today, for example, the rate was low, the rate can go up. So it really doesn't make too much of an economic impact whether rates are high at the point of time when you take a loan or not. Sentimentally, it does make a little difference, but it's not that significant. For a shorter term loan product, my sense is the impact might be more.
Can we expect softening of rates by RBI this year? If so, by how much could the rates from RBI get softened by?
Again, very difficult to answer that question off the cuff. But if the rate increase, to my mind, reached the peak of the rate increase. Now, data will have to be watched. I'm sure RBI will be very carefully monitoring, watching every bit of data that comes out of the system, inflation numbers, monsoons, and there are so many other oil prices, geopolitical issues. So there are so many factors RBI would consider. I don't know whether it's in the next 3 months or 6 months that they will start reducing rates. Economic growth continues to remain strong. So my sense is some degree of rate stability would happen for a while. And then at some point of time, RBI could start looking at reducing rates. But to put a number to it or to put a month to it is virtually impossible.
How do you see the impact on housing finance sector from the interest rates? Or what can this spell for your net interest margin and steady state of net interest margin? What could be your endeavor over there?
See, historically, we have always targeted a net interest margin which is between 3.3 and 3.5%. Every quarterly numbers that we've been giving you over the last several quarters, net interest margin range has been 3.2 to 3.5. This year, the net interest margin was 10 basis points higher than last year and stood at 3.6%. The last quarter, the net interest margin was even 3.7%.
Well, with the expected integration, how do you see the housing finance segment growing in FY24?
In my opinion, the growth opportunities for housing in the bank, in HDFC Bank are enormous. Today, the bank does not distribute housing loans from all their locations. But post the merger, it's certainly something that they would be able to do. Secondly, they have, if you look at the customer penetration, only 2% roughly of their customers have taken housing loans from HDFC. Another 5% have taken loans from other banks. So look at the ability to cross-sell to the 93% who have not taken a loan at all and to the 5% who have taken loans from other banks. So it's, according to me, a huge opportunity for the bank to grow.
What kind of cost may get rationalized over a period of time once the benefit of, the integration starts to kick in for the merged entity?
See, realistically, HDFC's cost structure is extremely low. We have probably the lowest cost-income ratio in the financial system in Asia and one of the lowest in the whole world for a retail financial institution. So obviously, when you marry the two institutions, the bank has a higher cost-income ratio, HDFC has a lower cost-income ratio. When the balance sheets and the P&L accounts get merged, logically, the cost-income ratio should come down. Having said that, the bank is expanding, they're setting up more branches, which may incur some amount of cost. So the immediate benefit of a sharp drop in the cost-income ratio may take a little while for you to see. But that's something the bank would be fully cognizant of because they're setting up so many retail branches where you incur upfront costs, but the benefit of those branches only come over a period of time as you raise more deposits, as you get more business through those locations.
Well, sir, the only point in your result was the massive decline in non-individual portfolio, almost by 11.5% on a YY basis and about 4% on a sequential basis. So what is happening over there? Why has the portfolio declined? And would you be comfortable if that book continues to run down?
Look, there are two parts to it. Part of this we had discussed even in the last earnings call. If you look at the non-individual book, we have three categories of loans. We have construction finance, which is currently about 7% of our total loans. We have lease rental discounting, and we have corporate loans. So these are the three segments of loans that we carry in the non-individual category. Our total non-individual loan today stands at 17% of the book. 7 is construction finance, 6, if I recall right, is lease rental discounting, and 4 is corporate loans. Now, construction finance loans, as we've been saying time and again over the last 2 or 3 quarters, the pipeline is healthy because the construction activity has started picking up. You've seen the huge demand for residential properties in recent times, and you see this reflected in the results of most of the property developers in recent times. So the demand is very strong. And as the demand, to satisfy that increased demand, more and more developers are looking at launching more and more and bigger and larger projects. Now, whilst we may approve loans for those projects, the disbursements for those loans will only come over a period of time. Whereas in a lease rental discounting loan, the disbursement is made upfront. So construction finance pipeline is healthy. Growth will come, but will come over the next 2, 3, 4 quarters. So that's one reason why the non-individual book growth has not been strong, because today what we would otherwise be dispersing is loans which would have got approved, let's say 2 or 3 years ago, when the demand for housing was not so strong, and therefore not too many projects were being launched. The second element is the fact that in our books, we have certain loans which don't comply with the RBI requirement or the bank's lending rules. So as these liabilities mature, as these assets mature, we've taken back the repayment of those loans and we've not given fresh money. So consequently, and most of the non-compliant funding from the bank, from the RBI or the bank perspective is broadly now completed. So I don't think we will see too much more of repayment of existing loans which are not compliant with the bank. So you would at some point of time, to my mind, and not too distant future, in a quarter or 2, start seeing the non-individual segment beginning to.
Okay, that's interesting. So retail housing segment has moderated. The growth has moderated a tad bit, but still very strong in terms of net interest margins, a 7-quarter high over there. And a lot of talk about the way forward as well. Siddhartha Khemka is still with us. Siddhartha, apologies, we had to interrupt you there because we sort of were awaiting the management commentary from HDFC. But you heard what Keki Mistry had to say. How are you feeling about this space in general and this stock?
Yeah, so I think the company reported very strong numbers. The management commentary yesterday as well as today, we heard him live. So it's pretty strong. And as the management highlighted, the high interest rates has not impacted the demand for mortgage loans so far. Yes, there is some moderation at the margin, but I think overall what the company is saying that they are witnessing increasing in the tenor, and about 10 to 15% of the loans that is getting extended to a higher tenor to adjust to the higher interest rates and the higher EMIs. But overall, pretty strong numbers. I think there is a huge upcycle in the overall real estate housing demand that we are witnessing that is being corroborated by the strong bookings that we are witnessing across real estate companies that have reported numbers. So I think overall, we are very positive on the housing real estate space, and that makes us positive on the housing space as well. In terms of interest rate cycle, we are almost at the peak with RBI taking the first step and pausing the rate hike. There could be one more hike based on what the US Fed does. But I think the merger will bring in synergies. The overall space and demand looks good. So overall, we have a very positive view on HDFC Limited. We have a target price of almost 3,300, which is a 15% upside from current levels.
Okay, all right, Siddhartha. Thanks for that. Noted your view, but just stay with us. For today, it won't be really the results. It's going to be that announcement that came in from MSCI that is likely to weigh in on the stock, as Vivek told us earlier. The street was hopeful for a multiple of that 1x, in terms of inflows. Now, in fact, there will be no inflows, but there could potentially be a small outflow of around $150 to $200 million odd. So HDFC Twins could be under some pressure. Well, we'll slip into a short break. You come back, Mitesh Thakkar as well as Kush Bora will be joining in for our technical trades, so you stay with us.